Welcome to the explainer. So picture this. You get a home loan, but you don't end up paying a single rupee in interest. Sounds impossible, right? Well, it's a bold claim for sure, but today we're going to dig into a specific strategy that claims to make this a reality.
All right, before we get into any clever tricks, let's just get real for a second. We need to look at the cold, hard truth of what a home loan actually costs you over the long haul. Okay, look at this number. We're talking about a pretty typical 40 lakh rupee loan. Over 20 years, the interest alone, just the interest, comes out to more than 46 lakhs. Think about that. You borrow 40 lakhs, but you end up paying back over 86 lakhs in total. More than the original loan amount is just pure interest going to the bank. It's just staggering. You know, when you see a number like that, you have to ask yourself, is this it? Is the only option really just to keep paying that EMI month after month for 2 whole decades? There's gotta be a smarter way to handle this, right? So what if I told you there's an idea out there, a pretty counterintuitive one, where you could get all of that interest money back? I mean, effectively making your loan interest-free. I know, it sounds crazy, but let's break down how this is even supposed to work. Okay, so the secret here isn't some special bank deal or a magic loophole. Nope. The core idea is to play the long game. You leverage the stock market. The plan is to build a completely separate pot of money and investment that hopefully grows big enough to wipe out the entire interest cost of your loan. All right, let's get into the nuts and bolts. The strategy is called EMI plus SIP. And it's pretty much what it sounds like. You're tackling your finances from 2 different directions at the same time. Now, most of you probably know what an SIP is, but just for a quick refresher, a systematic investment plan. It's basically a disciplined way to invest. You put a fixed amount of money into mutual funds every single month, automatically. This helps average out your purchase price, and most importantly, it gets the magic of compounding working for you. So this is the real game changer in terms of mindset. The old way, you get your salary, you pay your EMI, and maybe if you have anything left, you try to prepay the loan. All your energy goes towards that debt. But this new strategy says, hold on. You pay your regular EMI, of course, but you also carve out a small, fixed amount to invest in a mutual fund, SIP, at the very same time. So let's walk through it. Step 1. You get your home loan. Some people who follow this strategy even take a longer loan tenure because it makes the monthly EMI smaller. Step 2. You pay that EMI. Every single month, no excuses. But here's the crucial part. Step 3, at the exact same time, you start an SIP for about 10% of your EMI amount. So if your EMI is $40,000, you're investing $4,000. Okay, and here's where it gets really interesting. This whole thing can lead to 2 very different but both very powerful outcomes. It's not just one single goal. You kind of have a choice in how you want to win. All right, let's take the first path. We'll call it full recovery. So imagine you've got a 50 lakh loan. Over 20 years, you'll pay something like 54 lakhs in interest. Ouch. But if you were also investing just 5,000 rupees a month in an SIP, and let's assume you get a decent, say 13% average return, by the end of those 20 years, that little SIP could grow into a corpus of over 57 lakh rupees. And there it is. The interest you paid to the bank was 54 lakhs. The money you made in the market is 57 lakhs. You've basically recovered your entire interest cost, and then some. Your home loan, in effect, just became interest-free.
But maybe you don't want to wait 20 years. What about getting out of debt early? Well, that's path number 2, early freedom. Using the same numbers, something amazing happens around year 14. Your SIP corpus, your investment, actually grows to be bigger than the outstanding balance on your loan. At that point, you have a choice. You can cash out your investment and just pay off the entire loan. Boom, you're debt-free, a full 6 years ahead of schedule.
This right here, this is the magic moment. It's the crossover point. Think of it like a race. For 14 years, your debt was in the lead, but then your investment asset just pulls ahead and overtakes it. It's a fantastic feeling. Okay, I know this all sounds incredible, and it can be, but we need to pump the brakes for a second. Before anyone gets too excited, we have to talk about the risks and the reality, because this is absolutely not a guaranteed win. First and foremost, the big one, market risk. That 13% return we used, it's just an assumption. The market could go down, it could go sideways. Your returns are absolutely not guaranteed.
Second, discipline. We're talking about maybe 20 years of never ever missing an EMI or an SIP payment. That's a huge commitment. Third, this is not a get-rich-quick scheme. It relies on compounding over a very long time. And finally, you've got to think about taxes. You get tax breaks on your home loan, but you'll also pay taxes on your investment gains. It all needs to be factored in.
And this is something financial experts will tell you again and again. You've probably heard this quote, past performance is not a guarantee of future returns. It's a cliche for a reason. This entire plan lives or dies on one thing. Your investments have to grow faster than your loan interest rate. And that is never, ever a sure thing.
So after all that, where do we land? Is this a stroke of genius or just a really big high-stakes gamble?
Look, at the end of the day, it all comes down to a trade-off, a really big one. You're giving up the certainty of knowing exactly what your loan will cost you, and you're swapping it for the potential of market growth. It's a calculated bet. You're betting that over the long run, your investments will beat the fixed cost of your debt.
Now, obviously, this explainer isn't financial advice, but it does force you to ask a really important question about your own finances. When you think about your future, what's more important to you? Is it the comfort of a known, predictable cost? Or is it the potential upside that comes from taking a smart, calculated risk? The answer really depends on you.